Hi everyone, Michael Taylor here from shiftingshares.com. For those that don't know me, I'm a full-time trader of my own private capital. I trade my own opinions in the UK stock market for a living. I'm also the author of How to Make Six Figures in Stocks, available for free from a website, and I write for various publications such as Investors Chronicle and Master Investor. Today's presentation is going to be on the 3 keys of profitable trading systems, some things that I think will be helpful, and these 3 keys are position sizing, risk management, and then finally patterns. So let's get started on position sizing then, and position sizing is our first and last line of defense. Now, sizing is both an opportunity and a risk. We want to be large enough to actually make any money, but we need to be small enough to allow our size and allow our edge to play out in our trading. Position sizing is a common reason for trading failures. There's been a lot of accounts blown due to overexposure. Bigger positions lead to heightened emotions, and heightened emotions mean that we aren't trading in the optimal state, and this can lead to mistakes. Finally, consistency is a myth with position sizing. You shouldn't have the exact same position sizes, and this is because amateurs are consistent, whereas pros adjust the position sizes for risk, and this is something that we'll look at in the next few slides. So the goal of position sizing is to allow us to scale our account, and if we've got a trading account of £50,000 and we say our risk per trade, or our R, is 2,500, that gives us a total account risk of 5%. Now that's fine for now, but let's say we have 4 losing trades in a row and then we end up with a £40,000 trading account. All of a sudden our R per trade is still £2,500, but the account risk has actually increased to 6.25%. So we're actually taking on more risk even though we've steadily lost money in our trading account. So we absolutely must scale up when we're winning, but certainly we need to do this to protect ourselves when we're losing. So in this example, if we scale our down 20% to £2,000 account risk, then the account risk on a £40,000 account after 4 losing trades is now 5%. So this is why we need to scale up and down to protect ourselves. This is what professional traders do. They don't bet more as they're losing, because that's how you blow an account up. So be mindful of this when you're trading. If you do have a string of losers, maybe look to reduce that exposure and then scale back up when you start to win again. So we know that the numbers work for and against us when scaling our account up and down. Here's another example of how the numbers work against us on a drawdown. So if we look at the table, we can see if we have a 20% fall, we've then got to make 25% to get back to break even. But when we get to 40%, we then need to make 66% at least to get back to break even. At 50%, it's a 100% gain, and at 70%, it's over a 200+% gain required to get back to break even. So we can see the losses need to be cut small. You shouldn't ever be running such a large drawdown as 40% in my opinion, because it is very difficult to come back from. If you do find yourself in this position, something's gone wrong. The numbers do work against you, so be aware of that when you look to position your stop loss in the market. So we come now to adjusting for risk, and we adjust for risk because standard stops are pony, they're for amateurs, and professionals adjust for risk. So let's understand the equation. Monetary risk divided by risk per share equals the number of shares for a position size. So let's look at an example where our R is £1,400, and let's say we spot a potential trade in Delightful Drinks plc. The price to buy stock is 18.60 and support is at 18.40. However, we know amateurs place their stops on support. We're going to go below the stop loss liquidity at 18.25. So what we need to do is input the units. So our monetary risk is £1,400. Our risk per share is our entry price minus the stop price. So do the calculation now. I'll give you a couple of seconds to go through it. So if we go through the result of the calculation, our entry is 1860 and our stop price is 1825. Now we've got a monetary risk of £1,400 divided by our risk per share of 35 pence, because remember it's our entry minus our stop, and this gives us 4,000 shares in order to expose, so that is our position size. Now adjusting for risk is a very good technique to use when taking trades, because you don't want to have the same stop loss on every single trade, because that's silly. You might have a 10% stop, but support might be at 20%, and so you've got a 15% stop. Support is at 20% below. All you're asking for is your stop to get triggered out and gunned down, because that stock will likely trade towards support and take your stop out with it. So this is why we need to adjust for risk, because not every trade is the same and we shouldn't treat it the same, and we shouldn't be consistent with our stops in this way. So we move on to risk management now, and we already know losses work against us. There's a very famous chap, a money manager called Warren Buffett. You might have heard of him. He's actually very good, and he had 2 rules, and he probably still does have 2 rules. The first rule was don't lose money. Can anyone guess rule number 2? Well, rule number 2 is follow rule 1, and it's very simple, but it works. And if we remember, think back to the drawdowns slide, where if you're 50% down, you need to make a 100% return to break even. Warren Buffett understands the power of drawdowns and the negative effect that they can have on an account. And so his rule, first and foremost, is to protect capital and manage risk. So we need to protect ourselves then in the stock market, and I've come up with some risks here. There are far more, so do have a think about what can hurt you and how you can hurt yourself. One of the risks that I've come up with is liquidity risk. Now, even sets traded stocks can have thin liquidity. It is endemic on the London Stock Exchange. Be aware of EMS, that's exchange market size, because of the best execution rules. If you're 1 share under exchange market size, then if the market maker is offering a price outside of the spread, that trade won't trigger because the broker won't allow it. So do make sure that you're over exchange market size or NMS as much as possible, because if you want to get in or you want to get out in a hurry, you don't want to be calling the broker on the phone. You want to get that done electronically very quickly. So as I say, do be aware of that, because it is a big risk, especially if you want to get out of a stock very quickly. The second risk that I've come up with is emotional risk, and biases work against us. I'm sure everyone's aware of confirmation bias, where people are logging onto bulletin boards, looking for things of why they should hold. They're nursing a loser, but they want to find something that will verify their opinion. Or they'll be in these Twitter DM groups with everyone singing from the same hymn sheet. Confirmation bias is a big risk. There are many other risks. Anchoring risk as well, where we anchor the break-even price of where we buy. That price is meaningless, but we'll ascribe some value to it because of the anchoring bias. And we are at our most objective before we place a trade. So if we want to think about our stop loss first before we put the trade on, then we've got a much better chance of adhering to this, because when we place it before the trade is put on, we are stripping out a lot of that emotion, and we don't have an objective interest in being right. Finally, we want to automate as much as possible in order to take these risks out. So use a trading checklist come up with a list of things that you want to see before you buy, before you sell. Build consistent habits as well. And I did say earlier, consistency is a myth in position sizing, but consistency in general, in good habits, is what makes a successful trader. So to summarize this slide, do be aware of liquidity both on sets and sets QX. Do be aware of emotional biases, look them up, learn them, and automate as much as possible with trading checklists and build consistent habits. So this is a chart of Immupharma. It's a London listed pharmaceutical company, and we can see a very big gap down in the chart, and this was when the company ran a phase 3 trial for its acid Lupazor. Now, Lupazor failed to meet the primary endpoint for the trial, and so we saw a gap down of around 70%. Now, the problem here was that Beaufort Securities, the company's broker, ran a placing for its clients a couple of weeks before this phase 3 trial, and because Beaufort Securities went under, all of its clients weren't able to trade, and that means they were locked into this phase 3 trial with no way of buying or even selling the shares. Now, that is a huge risk because there's no way to hedge this equity. It's very high risk, high beta stock. There's very little correlation, or probably zero correlation, with anything else listed, so it's impossible to hedge, and all of Beaufort's clients had a long position in that stock. And the risk was that if the phase 3 trial that it didn't meet its endpoint, which we know now that it didn't, there was going to be a very large gap down, and Beaufort clients needed a way of hedging that risk. So what could they do? Well, what they could have done, or they could have tried to do, is open spread bet accounts and try and short as much as possible of the stock to net off their exposure. Now, I'm guessing probably those who are quick managed to do that, but in reality, it's never going to happen. Now, broker risk is a very real risk. Brokers do go bust. They can go under. We've seen several in recent years. SVS, Riker Securities as well, another one. There are plenty of brokers going bust, so do be careful where you hold your capital. And yeah, this, as we can see, a horrible risk, a horrible day. But these things do happen, and the only thing that we can do is prepare ourselves and try to minimise damage. And one of the ways that we can minimise this damage is to plan our trades and execute by having a plan that you follow, or something to keep you in check, something to build good habits can help you do that. This is something that I use in the morning, so I'll fill in a list of ideas, think about the risks, what can happen, where I'm getting into the stock, where I'm getting out. This is available from my website for all of my subscribers. So if you do subscribe to shiftingshares.com, you will receive my book and all of the other things that I give away for free. But if you know where you're getting out before you get in, this will reduce a lot of errors and it will save you money. So we come now to the final key, which is patterns, and what successful traders do is they develop a playbook of trades and they do more of what works and less of what doesn't. Sounds obvious, but a lot of people don't do this, and if you ask a lot of traders what's your most profitable pattern, they won't be able to tell you. So get serious about your trading, look at your results and work out what is your best pattern. One of the ones that I look for are breakouts on big volume, as well as cup and handle patterns, and we'll go through these in this section. So this is what a breakout looks like in theory. Of course, it never really happens like this exactly, but this is the idea that a stock breaks out of a predefined range, it pulls back, tests some stop loss liquidity, it's a breakout retest, and then it carries on forward. So why trade the breakout? Well, every stock that makes a new high has to break out of a previous high or range, because if it doesn't, then it wouldn't be a breakout. Breakouts offer high probability trading pattern entries. There are frequent of Mark Minervini, Stan Weinstein, William O'Neill, And the reason people use these things are because they work. And finally, it's a very frequent setup to trade, so one's never waiting around too long for a position. Here's an example of a stock that's broken out quite a lot over the years. AB Dynamics. So we can see I've drawn with the red lines resistance and breakouts, and we can see it's a lovely stage 2 uptrend offering plenty of trade entries. So I trade breakouts. I think they work, especially in bull markets, and they're very easy to trade. You can use something like SharePad to filter for prices that are 10% off their 52-week or all-time highs. This will give you a full list of stocks that you can keep an eye on to trade and then get in as the stock breaks through that resistance. Cup and handle patterns, another pattern which is a type of breakout, only usually we'll see a shallow bowl and then a little handle, hence why it's called a cup and handle pattern. And these work consistently, and you find something that works, you do it consistently. I've found cup and handle patterns to be very highly profitable. They're one of my best patterns that I look for, and so if you look on the charts, backtest these, see it for yourself, don't take my word for it, but these are powerful patterns, and this is one of my most consistently traded pattern. And what I've found is that if you play these patterns with good risk management, you're not betting the farm on any single position, you use position sizing, then you can be a profitable trader just by trading the cup and handle with good risk management. It sounds easy, and in theory it is easy, but most people don't just want to do one thing, they want to test a lot of things, they're never really sure what they want to do, they see a new stock and they jump in. You do need discipline to be a trader. If you can't discipline yourself, then I'll give you a bit of advice. Don't even bother, because it is a hard business. You're not owed anything in trading, and if you're not going to put the work in, you're probably not going to succeed. So we've come to the end of this presentation now, and I'll leave you with some key takeaways. First of all, position sizing protects you. Don't go too big, don't do anything silly, but at the same time, it's got to be big enough to mean something. Vary your position size, keep risk consistent, don't use the same position size all the way because it's just not going to work. You need to adjust for risk, remember, and if you adjust for risk, you are going to get better trades. Scale up when winning and scale down when losing as well, because remember, don't try to fight the numbers will always beat you. It doesn't matter how tough you are. If you're 50% down, you need to make 100% to break even, so just don't try to fight them. Be aware of emotional and liquidity risks. Think about what can hurt you and use that. Automate and checklist everything possible. Come up with lists of entries, exits, position sizing. Trade breakouts on big volume. That's one of my most profitable patterns. And cup and handles are superior breakouts, in my opinion. And finally, stay in business using all of these keys and allow your edge to play out. Because if you can stay in the game, most of the time we're in bull markets, and if you're long in a bull market, you'll make money. It's when things go wrong and people don't have good risk management that they see themselves carted out of the market. Finally, thank you very much for your time. Thank you for listening. I do appreciate it. If you want to follow me on Twitter, you can do so at Shifting Shares. Or if you have any questions about anything that we've talked about in this presentation, you can email me at michael@shiftingshares.com. Thank you very much.